All right, let's dive into one of the biggest economic puzzles of the past year. It's a real head scratcher, a story that involves some pretty scary predictions, economic data that just didn't add up, and a mystery that honestly is still playing out. So here it is, the big question. In 2025, the US economy got hit with this enormous tariff shock. I mean, all the alarm bells were ringing, and everyone was bracing for a crash. But nothing. The economy didn't crash. The chaos just never showed up. So, what on earth happened? To really wrap your head around why this is such a big deal, you have to understand the sheer scale of what we're talking about. This wasn't some tiny little policy tweak. No, this was a massive, historic shift in trade policy, the kind of thing we haven't seen in nearly a century. I mean, just look at this chart. The average tariff on goods imported into the US didn't just inch up, it absolutely skyrocketed. We went from a pretty normal 2% all the way up to a staggering 18%. That's a huge jump.
Now you see a spike like that, and yeah, the predictions were pretty dire. Economists were forecasting a severe supply shock. The thinking was straightforward, right? Higher tariffs mean higher costs, which means surging inflation, less money in your pocket, and ultimately people losing their jobs. But then, the actual numbers started coming in, and the reality looked nothing like the prediction.
So let's actually dig into that data, because this is where the mystery really deepens. We're going to unpack why that economic storm everyone was so sure was coming just never seemed to arrive. Okay, look at these key indicators. Consumer price inflation at the end of 2024 was 2.7%. A year later, after this massive tariff shock, it was 2.7%, exactly the same. And unemployment, it barely budged, just a tiny tick up to 4.6%. This was not the economic catastrophe we were told to expect. So this is the real mystery we're trying to solve. What happened? Why was the impact so quiet? Did all the economic models get it totally wrong? Or was the economic pain just delayed? Well, and this is where it gets really interesting. It turns out there isn't one single, simple answer. Instead, the analysis points to 4 key reasons that all work together to basically postpone the tariff's biggest effects. So let's break it down. Think of it as 4 crucial pieces to this economic puzzle. You've got data gaps, a softening of the policy, some clever stockpiling, and someone absorbing the cost. First up, the data itself was a bit of a mess. There was a US government shutdown for over a month, which meant the collection of crucial data on things like inflation and GDP got delayed. So for a while there, we were kind of flying blind. Plus, some of the figures that did come out are considered pretty unreliable. Reason number 2? The policy's bark turned out to be way worse than its bite. Some of the absolute highest tariffs got pushed back again and again. Key tariffs on groceries, they were actually rolled back in November. And, critically, huge exceptions were made for our biggest trading partners, Canada and Mexico. And the third reason, well, businesses aren't dumb. They saw this freight train coming down the tracks, and they got prepared. Companies started stockpiling imports like crazy, building up these huge inventories of goods before the new tariffs actually took effect. And let me tell you, that strategy paid off in a huge way. We're talking an estimated $6.5 billion saved by importers just by loading up on goods early. That created this massive financial cushion that absorbed a lot of that initial shock. And that brings us to the fourth, and you could argue, the most important piece of the entire puzzle. The costs were very real, but for most of 2025, you, the consumer, weren't the one footing the bill. So here is the crucial takeaway. The theory was that foreign exporters would have to eat these tariff costs to stay competitive. But that is not what happened. The evidence clearly shows it was American companies, the importers, who took the financial hit. And this chart really just says it all, doesn't it? A staggering 90% of the new tariff costs were absorbed by US importers. Only about 10% of that cost actually got passed on to consumers in the form of higher prices. Businesses just soaked it all up. Which, of course, leads us to the big, blinking question mark hanging over everything. How long can that possibly last? I mean, businesses can't just absorb losses forever, right? The best analogy here is a sponge. Throughout 2025, American companies acted like this giant economic sponge, just soaking up all those extra tariff costs. But you know what happens with a sponge? Eventually, it gets completely saturated. It just can't hold any more water. And that's the bottom line. It all comes down to a simple business concept: eroding profit margins. When your costs keep going up, but your prices stay the same, you make less money.
And no company is going to let that happen forever. At some point, something's gotta give. So where does this all leave us? Well, it means the story of the 2025 tariffs isn't actually over, not by a long shot. You could say the final verdict has been delayed, not dismissed. The consensus among economists now is that all those effects we expected to see in 2025 were simply postponed. They're very likely coming in 2026. So what should we be watching for? Well, probably more price increases at the checkout, a real squeeze on incomes, and maybe even layoffs as companies are finally forced to adjust to these higher costs. And that leaves us with this final massive question. Was 2025 just the quiet calm in the eye of a much bigger economic storm? Or have all these unique factors somehow changed the forecast for good? I guess we're all going to find out, together in 2026.